Imagine this. You finally find your dream home and lock in a deal. But then interest rates surge unexpectedly. Your monthly payment could shoot up by hundreds of dollars, a scary surprise for any homebuyer. What can you do to avoid that? That's where rate locks come in. So what exactly is a rate lock? It's basically a promise from your lender that your mortgage's interest rate won't change for a set period of time. In other words, once you lock in a rate, say 6.5%, that rate is guaranteed while you finalize your home purchase or refinance. Even if market rates shoot up the next week, your locked rate stays put. It's peace of mind during a chaotic process. Why do rate locks even exist? Because mortgage rates can fluctuate daily, sometimes wildly. The rate you see today might be gone next week, or by the time you close on your home. A rate lock protects you, the buyer, from those surprises. It's there so you don't get squeezed by a higher payment if rates rise during the weeks it takes to close your loan. Essentially, it gives you certainty in your budget. No matter what happens out there in the market, be it a Fed announcement or sudden inflation news, your rate and your monthly payment are safely locked in. Now, a rate lock isn't open-ended. It lasts for a specific duration. Common lock periods are 30 days, 45 days, or 60 days, though some lenders even offer 90 or 120-day locks for longer situations. Think of it like a ticking clock. You have that many days to close your loan before the lock expires. For example, if you lock for 45 days, you'll need to complete your home purchase within that time frame to keep your promised rate. Tip: choose a lock period that comfortably covers your expected closing date. If you think you'll close in a month, a 45-day lock gives a cushion for any delays. But remember, longer locks may come with higher costs or fees. So when should you lock in your rate? Most homebuyers lock after their purchase offer is accepted and they're in the mortgage process. At that point, you have a target closing date, so you can pick an appropriate lock period. Generally, if rates are trending up or volatile, it's smart to lock in as soon as you're able. That way you're not caught off guard by a spike. On the other hand, if rates are falling or you believe they might drop, some buyers choose to float the rate a bit longer, essentially waiting to lock. But be careful, floating is a gamble. You might snag a lower rate if you guess right, or you could end up with a higher rate if the market moves against you. Let's talk about what can happen between the time you start your loan and the day you close. Mortgage rates can change overnight based on economic news, inflation reports, Fed decisions, you name it. It might take 30, 60 days to close on a home, and in that period rates could climb significantly. Locking early protects you. If you lock at, say, 6.5% at the start, and by closing day rates for new loans have jumped to 7%, you're still safe at 6.5%. You won't pay a penny more. But if you don't lock and rates rise, you'd be stuck with that higher 7% rate and a higher monthly payment. That's the risk of waiting too long. Meet Alex, a first-time homebuyer. Alex got an accepted offer on a house, and his lender offered him a 6.25% rate. He decides to lock it in for 45 days. Meanwhile, his friend Jordan is also buying a similar home, but chose to float, not lock initially. Now, over the next month, suppose overall mortgage rates jump to 6.75% due to some market changes. Alex closes on his home loan at 6.25%, just as he locked, no surprises. But Jordan? By the time Jordan goes to finalize his loan, he ends up with 6.75% because he hadn't locked earlier. That's a difference of 0.5%. What does that 0.5% mean in dollars? For a $300,000 mortgage, Alex's monthly payment at 6.25% is around $1,847. At 6.75%, Jordan's payment is about $1,946, roughly $100 more each month. Over a year, that's an extra $1,200. And if they kept those loans for 30 years, Jordan would pay tens of thousands more in interest, all because he missed the chance to lock in the lower rate. Now, life isn't always neat. What if things change after you lock? Say your closing is delayed past your lock's expiration. Most lenders will let you extend the lock, but it might cost a fee. And what if rates drop after you've locked in? This is where a float-down option comes in. A float-down lets you adjust to the new lower rate one time if market rates fall enough, usually for a fee and under certain conditions. Finally, if your lock expires, you can always relock at the current market rate. But that new rate could be higher or lower than before. By now, you can see that rate locks are a powerful tool to keep your home buying journey on track. They offer protection and peace of mind in a world of ever-changing interest rates. Knowing when and why to use a rate lock can save you from surprises and potentially save you money in the long run. If you found this helpful, we've got something for you. Please subscribe for our free 10-step home buying guide. It's a handy resource to walk you through the entire process from start to finish. You can download it, just click the link in the description below. This is for educational purposes only, and not for financial advice. Program rates are subject to change. Consult a licensed loan officer for advice.